Well, good morning, everyone. Welcome to the Investing Master Series. My name is Barbara Armstrong, and I have the privilege of filling in for Mr. James Boyd today. So I hope he's off having fun as we enjoy this spring blizzard here in the Salt Lake City area. Today, we are going to share the love. And what do I mean by that? Well, we're going to look at some bullish opportunities and embrace those, but we're going to do it in a way, what's that joke? How do you hug a porcupine? Very carefully. We're going to, embrace those bullish opportunities like we would hug a porcupine very carefully. We're also going to give a few bears a hug, and we're going to look at some perhaps bearish or bearish to neutral opportunities, and how are we going to approach those like we would a porcupine, very carefully. So there's a lot of very carefully happening today, but one thing that we aren't doing is the ostrich approach, which is sticking our head in the sand. We're looking for opportunities, and we're looking for ways to take advantage of opportunities that the market presents to us, rather than closing our laptop, which on some days, I have to confess, is quite a temptation, and just going and doing something else until the market stops whipping us around. And one of the things that the market likes is stability, is consistency, is like just boring day after day. And we haven't had a lot of that lately. And, and there's still a lot of uncertainty in the market with tariffs apparently, coming tomorrow and all of that. And so we are going to kind of tiptoe through the tulips and do what we can. Okay, so I invite you to follow me on X, my handle, Barbara Armstrong CS. Kevin Horner is with us in the chat. He's a great guy, a fellow coach, and you won't want to miss following him on X also, Kevin Horner CS. We have a lot of the usual suspects with us, in class today. So hello to Will and Grace and Mark and Frank and all the rest of the gang, Gary and Alfred and Riceburg and Life in the Fast Lane. Thank you all for being here. I do appreciate it. And I know that when I was a client, if it wasn't the instructor I expected, I often didn't stay. And I thought, okay, I've got a free hour here. So I appreciate you staying. And, if you haven't come to my classes before, I hope that you'll, stick around and keep coming back. Because along with James, I too do teach every day. Know that we're going to look at some option strategies. Options carry a high level of risk and aren't suitable for all investors. We'll do our example trades on the Paper Money software application on the Thinkorswim desktop platform. Looks like, smells like, feels like real money, but it's not. So it's a great place to learn. Make sure you understand your trading strategies and have a plan and follow it, which really helps us deal with fear and FOMO, those four-letter words that can really derail us in our trading efforts. One of the differences is that short options will never be assigned early. In Paper Money, that can happen in a live account. Okay, so let's get out to the markets. And if you're not following, Kevin Horner does a really great class most mornings at the market open, and he goes over what's going on in the markets, and you're going to want to check that out. And because he does such a superlative job, I am spending a lot less time in these classes where we're trying to pack as much as we can into our 45 minutes. So watch those. But if we look at the S&P 500, we were officially in correction territory, and we're still in that neighborhood, right? Because we had this pullback that was over 10%. We had this diagonal resistance breakout, and Chicken Little started slowing down a little bit, wasn't running at quite a rapid a pace around the yard. People started humming, the sun will come out tomorrow. And we had a pullback, it came up, and now it's come all the way back down. And, it was a down day when I taught yesterday, and then it rallied throughout the day, and looks like this may be happening. This support level may currently be holding. And where might we go from here? Well, no one knows. My crystal ball has been in the shop for quite some time now, but could we end up, going sideways? Just let me grab my drawing tool here. Doesn't seem to want to come over. Could we end up in this a period of going a whole lot of nowhere? We could. And are there ways that a trader can profit from that? Absolutely. But could this come back down and break to the downside? Yes, it could. And then could it just continue on its way up? So we don't trade what we think, we trade and invest based on what we actually see, right? And sometimes we have an expectation. And so we'll place a conditional entry. And I know James has talked a lot about that. We placed several conditional entries last Wednesday in the trading price patterns class. And then we almost threw our shoulder out for patting ourselves on the back because we, managed those trades in trading a smaller account yesterday and canceled all of them. And so what did that mean? It means that what we expected to happen didn't happen. And we, prevented ourselves from placing what would have been unsuccessful trades. Just a second. I didn't mean to do that. Let's bring that back up. Okay. And then let's have a quick look at the NASDAQ. This pulled back even further. It was more like 13%. I mean, when we look here, down 15% off the February 19th high, that's kind of take your breath away. And it has a lot of people feeling anxious about what's going on in the market. But, yesterday we opened down, rallied throughout the day, which is why this candle has a red. We still closed down on the day, but just by a smidge. And, and today, it's looking to move to the upside. But, here was a low and a lower low yesterday. So this was a 6-month low we hit yesterday. So we're still not in the clear. And what do we do with this? I say, what do you do when you live in a shoe and people keep stepping on you? Well, you tread very carefully. And somebody's saying, bullish divergence. And yeah, so we have a new low here. And you know what we're going to talk about today in getting started with technical analysis? Divergences. And so could this be drawing to a close? It could be. And this is one piece of information. And so what do we mean by a bullish divergence is that we hit a new low yesterday, and yet we're not hitting new lows on the MACD. This, line is uptrending. Well, this is, if anything, downtrending. Okay. And we're going to see lots of different types of divergences today. And sometimes divergences are a sign that times may be a changing or this pullback may be waning. And sometimes it's just an anomaly. But it's another piece of information that we can kind of tuck in our pocket, right? Okay. And what's happening with the VIX? Well, it's interesting, right? Because yesterday the VIX opened high and closed lower, while the indexes opened lower and closed higher. So, the VIX is doing exactly, what we'd expect it to do, but it's still at almost 22, which is in the high end of the range where it's traded for the last, not only 6 months, but the last year. Okay. So let's come and look at, let's come and look at GE. I know this is a stock that James has often used as an example. So this is GE Aerospace. And, while the market has been on the struggle bus a lot of this year, we're looking at a stock that is year to date up 20%. That is, that's pretty stellar, right? And it had this pullback and then a diagonal resistance breakout, pulled back for a day. So was it a breakout or a fake out? Looks like a breakout because it bounced, came up, came back down, retested this diagonal line, and is moving again to the upside. Now we have, and this is our hugging a bull part of the program, and so we have earnings coming up on the 22nd. And if we want to be, cautiously bullish, what might that look like? because sometimes James will call himself James Fibonacci Boyd. I think this year we could call him James Caller Boyd, because he's talked a lot about the importance of callers. And you might say, ooh, like callers kind of make me itch, and they put a bracket, but what callers do, if you're not familiar with the concept of a caller, is, and let's say we don't own this stock, is we want to protect ourselves to the downside. Given what has gone on in the market this year, might this be a wise idea? I would say, that might be prudent. And so what we're looking to do is sell a put, buy a put. Now, when we buy the stock and we buy a put at the same time, what do we call that? Dun, 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 dun. It's a married put, because we're buying the put at the same time as the stock. So we're marrying the stock to the put. And this gives us coverage just in case things don't go according to plan. And, if we look at the last two earnings announcements here, it skyrocketed and gapped up substantially. The one before that, oops, it gapped down and then kept on falling and then continued to fall for a period of months. So we're looking at a married put. Now, when we buy a put, is that free? No, it costs us money. And I say, like Kevin Horner recently went to Europe, and I didn't talk to Kevin about this, but if I were a guessing person, I might guess that he perhaps bought some type of coverage just in case he fell while visiting the Parthenon in Greece or wherever he was in Rome, in case he fell and broke his arm. He may have had some type of coverage. And yet when he got home, safe and sound and didn't need to use that coverage, did he get his money back? No. Was he glad he bought it still? Yeah. Yeah. So, we're buying this protection, and the hope is that we don't have to use it. We would like nothing more than to get here and to see this kind of activity again, a jump up. But just in case, we've got coverage. And then what we can do up here is sell a call. And why would we do that? Well, if we sell the call, it can help fund the purchase of the put. And this, my friends, is called a caller. And you're saying, well, you're capping your potential gains. Yeah, we are. But it still gives us the opportunity to make a gain, which beats us saying, I'm not sure about what's going on in the market right now, so I'm going to close my laptop and do nothing. And this stock is up 20%. And so, might it have made sense? Would we have been beating ourselves up had we done a similar type of trade back here? And we probably would have been pretty happy campers. Well, if the idea is somebody's saying, well, when would you close the put on a stock that goes up? Well, so let's go in and have a look at this. Okay, so it's trading at 203. We might say, maybe we want to, sell a put maybe around that 190 or 195. And our recent high here was 215. So could we sell the 215 and then maybe buy the 190 or 195? And when was earnings? Earnings is April 22nd. Okay. So now we have our bits of information. So we could come out here and look at the weeklies. Now, one of the things we want to look at, does this trade more than 1 million shares a day? Yes. If we look at the weekly options, do we have a tight bid-ask spread? So if we look at the 190 or the 195, like the 195 to go out 31 days would cost us $5. Like, that's not cheap. If we go to the 190, now we're risking then $13 a share, but we know that when we buy a put, we have the right to sell the shares at that price. Now, if we do the 195, well, now our risk is $8 a share plus the $5. Could we come out here and sell the 215 at 435 and cover most of the cost of this put? So we're going to look at doing that. So we're going to say, okay, if I sell this 215, and it's saying here, you've got a 60% chance of it coming up and touching 215. You've got a 20, almost a 30% chance of it being in the money, a 25-cent bid-ask spread. So we're going to right click and we are going to, buy covered stock. Okay. And then we're going to come to our single order, make it a first trigger sequence, and come back up here to the 195, and we're going to buy the put. Okay. Okay. Now we might see if we could buy that put for a little less because, there's, a 25-cent bid-ask spread. Now that meets our parameters, but, maybe we could get it for 520. You can always ask, you can change your price if you have to. But, so if we look at this, what are we paying all in? We're paying 204.58. And what's the most we can make is 215. So if I come in here to my calculator and say, okay, the most I can make on this, if it goes up and we get called out, is 215 minus 204. Let's just call it 204. Did I already put my minus in? Yeah. So 215 minus 204, 76. Oh, crap. I can't go up there and add. Oh, maybe I can. Let me add the 0. It won't. Okay, 204.76. Okay, I'm just going to do it on my calculator because obviously I can't work this calculator, but it's about $10. So if you look at that and you say, well, I could make about $10 because that 215 is the most we can make minus that 204.70. If I can make about $10 on this, $10.30 if we want to get specific on that investment of 204, that's about 5%, 4.2. So if we look at that and say, well, that certainly beats a poke in the eye with a sharp stick if we get called out. Now, what if it goes up past 215 and then comes back down and closes around 214 and change? Well, this would expire worthless, or we could buy it back. May not be worth much if it moves up on earnings. And our covered call could expire worthless, and then we could sell another call. Okay. So that's what we're going to do. And we know that we've got protection to the downside. We know that we can be called out. If we're called out, we're okay with the results. Okay, so confirm and send. And I don't know if I have a caller group. I do not. So we're just going to go ahead and put this in. And then we can create a group for it. Okay. So that is GE. Now, if you want to see another example like that, we could come and look at CVX. So somebody's saying, hey, could we do this? And like if we already own the stock, could we add the caller? Absolutely. Absolutely, we could. Now, here's another stock that is, bucking the trend of the general market, CVX. This is in the energy sector, right? And when we look at this, do you see what I see? A bit of a, cup and handle. and then it's broken out. And so we can have a diagonal pattern on these things. You know, and then, you know, when it broke out, man, it didn't even look back. It just came up. And now we have, you know, what would you call that? Bull flag. You know, if I was playing I Spy with my little eye, that's what I see, this bull flag. And then do we have a close above the high of the low day? Yes, we do. Thank you for asking. So, you know, when we look at this and we say, okay, could we do the same kind of thing? Because we have earnings coming up. And again, not with quite as much drama, you know, as GE, but, you know, last earnings, it fell kind of dramatically and, you know, then eventually rallied, you know, and then the earnings before it gapped up and then continued up. And so, you know, you never know what you're going to get. You know, as Forrest Gump would say, life is like a box of chocolates. So we want to be prepared for whatever we do get. In this one, we've got earnings on May 2nd. So we want to go out past May 2nd. And so could we come out here? Well, here is May 2nd. So this is the day of earnings. Could we come out to May 9th? Because both of these are weeklies, or even come all the way out to, you know, and this is not a terribly volatile stock. Could we come out to the monthlies? Now, what's the advantage of the monthlies? Look at the number of contracts. Look at how tight the bid-ask spread is. You know, we're here, the bid-ask spreads are a bit wider, right? So let's look at this May monthly, and we're saying 167. So we're close to our high here. What if we went to could we get some premium, decent premium, 172.50, 175? And then on the downside, where might we want to be? Well, maybe, you know, below that 165. So what if we said 160? You know, we've got a lot of contracts here. Now we could do 165, but if we came up here to 175, you know, we're giving ourselves a potential room for almost, you know, call it 168. So $7 worth of gain. And then we're selling our covered call for 225. And then we can use this money to buy ourselves some protection here at 160. So we're risking 8 to make 7 or 8. Okay. Yes, we're looking to sell the call. Sorry, did I say buy the call? If I said buy the call, I misspoke. So, but what we're doing, this is just the way that Thinkorswim labels it. We're buying 100 shares of stock, and then we're selling a call and buying a put. So in the system, they call that buying covered stock, because we're buying the shares of stock and selling the covered call. And then we're going to come in and add our protective piece at the bottom, which is we want to add the put. Okay. Yes. So we call that buying covered stock. It's the equivalent of buying 100 shares, selling a call, and then we're adding our married put. Okay, so again on this one, you know, it's 165.69 plus 198. So it's 167.67. And the most we can make on this, if we are called out, now there's no saying it'll go up that high. It's saying we've got a 56% chance of it coming up and touching, only a 28% chance of it being in the money. And so if it, let's say it closes at 173, we'd get to keep this 232. This would expire worthless, or, you know, we might buy it back for a modest amount after earnings. You know, but 175 minus 167.67. And why am I going through this exercise? Well, because it's like, is the juice worth the squeeze? Is it worth risking potentially losing $800. How much could I make and what percentage is that? So if I divide that by our entry price, the 167.67, the net cost to get in, you know, that's another 4.3%. Yeah. Okay. So confirm and send, and we'll put that in our caller group. Okay. Fire in the hole. Okay, I'm going to talk more about these strategies in the after the close class on Thursday if you want to see more on that. But I know James talks about that all the time. So, you know, there was our attempt, there were our efforts towards, hugging, embracing the bulls, in a cautious way. And although it can potentially limit our upside, it also gives us an out. So that if the stock were to gap down, if we had a stop loss in place, it could get triggered and we could end up out at a lower level than what we were looking for. Now, are there other opportunities, to place similar types of trades? You could look at Walmart, for example. There are other stocks out there if you wanted to practice this buying a stock and putting a collar on at the same time type of strategy. Okay, so let's go and look at a couple of other scenarios that, we're now going to go over to. If we're at the zoo, we're now going to go check out the bears. So we have Disney, and I'm a fan of Disney. I will say I like their product. I'm a bit of a Disney girl, not as much as Ben is a Disney boy, Ben Watson, for those of you who know Ben Watson. But this hit this high back here in December and has kind of been struggling since. And recently it was like it just kind of took a tumble off the wall, didn't it? And broke down somewhat dramatically. And then has tried to rally, and it seems, it's having trouble getting back above this 100 and staying there. This hit a high of 102, but could we come in and look at this and maybe do a short call vertical? And because it seems, to have fallen and then kind of been going sideways, and it looks like, it's falling again. And so could we come up here and just, if we're, nervous about timing, maybe we want to look at a shorter time frame. So if we came to the weeklies, now what's the advantage of a shorter time frame? Is if we're looking at selling something, time decay is going to happen faster. What's the downside? Well, the downside is that if it rallies, we have less time for it to recover. And if we sell this 100, or maybe we could sell the 101, let's see what we get here. And what we're looking at here is a short call vertical. And I know that most of you are probably familiar with this strategy, but if we did this 100, 103, we'd get 55 cents. And we're looking at coming out 24 days. Well, is that worth it? Well, the most we can make is 55 cents a share, or $55 a contract. And what are we risking? $145 because we have a $2 wide spread. Well, that's almost a 38% potential return for a trade we'd be in for 24 days. And if you go to the trade management mini series, I do have an example trading plan in there for a short call vertical. If we're in for 24 days, we want at least a 24% return. Now, some might say, I don't care how long we're in. If I don't get a 30% return, I'm not playing. Like, you can make your plan whatever you want it to be, but I encourage you to have a plan. And if you go and you watch that, you'll see that, some of the components you might want to include in a trading plan, and then you can customize it and make it your own. But if we said, hey, this is a close to a $500,000 account, if we're willing to risk $1,000, if we're risking $150 a contract or thereabouts, if I divide this by 150, we could do 6 contracts. So if we do 6 contracts and we might say, hey, you know, I'm going to be traveling a lot. So just in case this really has a down day, if it hits 80% of its max gain, I'd like to buy it back. Now, I know that James, you know, has often said like, hey, if we have 50% of our max gain in a few days, might we just choose to take it? Absolutely. Especially if there's a candle indicating that it might be about to rally. And so we're going to make this good till canceled. Okay. And confirm and send. How much could we lose? $882. What's the most we can make? 318. I'm just looking at the chat. If somebody was joking, I missed it. Yeah. Maybe their joke was that they thought the market was going to gap up. I'm not sure. It could. You never know. Do I have short call verticals in here? You know, this isn't an account that I actively trade, which is why I'm using this today, but I'll put that into our short call vertical bucket. We'll create one. So there we go. So there's Disney. And if you're not familiar with this strategy, the idea here, and we were looking at selling the 101. So I'm just going to put this on the chart. 101. Oops. Showing it on the right. So the idea here is that our expectation is that Disney will stay below 101 until April 25th. So for the next 24 days. And so, you know, if this stock continues to fall, as it has been, sorry, Disney fans, if it continues to fall, you know, we're happy campers. What if it goes sideways? Well, if it goes sideways, you know what? So if it goes like this, as long as it stays below 101, you know, and right now it's at 97.79. So, you know, we've got, you know, $4 to $5 worth of wiggle room here, still happy campers. You know, it can even come up a little bit. We've got some room there and we're still smiling. Where, you know, our frown turns upside down is if it breaks through here. But we position size so that we aren't going to blow up our account in the event that this does break above. Okay. Okay. So that's that one. Okay. Would you like to see another one that might fall into this, you know, embracing, you know, the bear? So we've done that one. We've done these. Okay. Let's look at CRM. Well, what are we seeing on CRM? What kind of candle pattern? And, you know, I'm creating this series, this you know, short series. There's going to be about 18 of them, but they're all like 3 to 5 minutes long. What kind of candle is this? You know, we've seen it pull down. You know, we have something that's been downtrending, rallied for a day. What do we call that? I always think of it as a hammer, but technically, if it's bonking its head on what might become resistance, you know, was support, we call this a hanging man. But with a hanging man, we look for confirmation. And what is confirmation? Confirmation would be is if tomorrow it closes below the body of this candle. Yes, Andrew and to Tatiana, I think of it as a hammer too, but Mark has it right. in the dictionary, in that little short video I did, we call it a hanging man. So we don't have confirmation. So if we wanted to be aggressive, we could place the trade anyway. If we want to follow a more conservative set of rules, and it seems like conservatism might stand us in good stead these days, we might just say we're going to wait. Okay, how about NVIDIA? NVIDIA in the talk of the town for quite some time. Anybody see, what do we see? Yeah, Wiley is saying, we could do a conditional order. Yes, we could. We could do a conditional order. Now, what I'm going to do is put it on my list to talk about potentially tomorrow in trading price patterns. So, if you want to see what we might do with that come tomorrow, come to trading price patterns at, I don't remember if it's at 11 o'clock or Mountain, which is 1 o'clock, or I think it's at 11. So that's 1 o'clock Eastern. So, are we seeing a similar pattern here? Now with NVIDIA, what I'm seeing, is this, it's down in a downtrending range. And, yesterday it came down and then rallied, but still closed below. Like we've now had 1, 2, 3, 4, 5 down days in a row. So far today, like at this moment it's up, but when I first put this on my list, it was not. So could this be another bear flag setting up? Yeah, it could. So what do we call that again? Hanging man. So what do? We wait. Is waiting a strategy? Yes, it is sometimes. Yeah. Yeah. Okay, so we're waiting. I wasn't waiting when I put that one on my list, I'll tell you that. CRM, we're waiting. So that one's a wait. That one's a wait. We did Disney. Okay, how about AMAT? Okay, what do we call that? Same thing. Same thing. And so with these, what are we going to do? We are going to wait, and see if we get this confirmation tomorrow of a close below the body of this candle. And if we do, then we can come in here. Now, what might you want to do, in the interim? You could, have a look and just see, what the bid-ask spreads are like. Like, do you want to continue to have it on your list? Okay, so if we look at Celsius Holdings, this was downtrending and it's now broken out and is continuing to move to the upside. So, and this stock is up like 41% year to date. Like that's quite extraordinary. And if you're into drawing lines as I am, when you draw your line, as James often says, you just want to hit as many as you can. We had a breakout here, came up, 1 day pullback, came up, 1 day pullback, up 1 day. It's now hitting a 6-month high. And this, at one point was trading at $100 a share. It's now at, 37. So, and it may never get back up here. We can get rid of these. So, and if you're not familiar with this company, you can come out and go, oh, it's a staple. So functional energy drinks. Now, some might think that, functional energy drinks are not a staple. I happen to not think Coca-Cola is a staple either, but nobody asked me, So, but could we do this same idea? Because we do have earnings coming up in May, so could we do this caller idea? Does it trade over 1 million shares a day? Yes. Do we have lots of volume, on the options? Yes. So, could we come and say, if we were to put a stop on this, where might we put it? Well, we might say below this low of 33.19. So could we come out here and maybe, buy a put at 32.50 and then sell the 40. You know, and if we make $3.50 on the stock, well, it's a $36 stock. You know, so that would be another bullish. Okay. That would be another, you know, embrace the bulls. So we're looking again to buy covered stock, which means we're buying the shares, selling the stock. This is a less expensive stock. So we could do, you know, maybe 200 shares. And I haven't spent as much time on, you know, position sizing, but we do want to limit our risk, right? And then if we come here to our 3250, we have to change our single order to first trigger sequence because we're adding this and we're saying, hey, if this fills, then I want to buy this put as well. Okay. $1.95. And again, if you do this calculation, so what have we spent? $34, almost $36 to get into this. So $35.90. So how much can we make? We can make about $4. You know, but if we are called out and we make that $4 on a $36 investment, that's over 10%, right? So 4 divided by 36. That's 11.1%. Sounds like a pretty good deal. Okay, confirm and send. We're buying 2 covered contracts, which means we're buying 200 shares of Celsius. We are selling 2 covered calls at 40. And then we're buying the protective put at 192. You know, or the married put. The prenup put, as somebody said earlier. Okay, so guys, I had one other thing that I wanted to show you, and that is Trader Talk. So here's, you know, where we do our short commercial break. And so, you know, we have done 4 trades today, and then we put some on our wait list. So we did one on Celsius, one on GE, and one on CVX. And then we did a short call vertical on Disney. Now, if you know, you're going to want to hit that subscribe button if you haven't already done so in the bottom right corner of your screen. But if you come down here to under the playlists, sorry, and we want to come to trade management mini sessions. So at the top for now, I've got these short candlestick pattern. You know, here's what is the shooting star. You know, it's all of these are going to be 3 to 5 minutes long. If you haven't watched this Power of Compounding, I encourage you to do that and then share it with your kids, your friends, your family. And then here are the, you know, here's our short call vertical example trading plan that we talked about. I don't have one in here yet for callers. And then at the very bottom, there's a whole bunch on just how to customize your charts or a watch list or the monitor tab, all that kind of stuff. Okay, so it's just another resource. You know, it's a cupboard full of kind of things that can be helpful. So if you've not ever gone over there and checked it out, I encourage you to do so. I'd also encourage you to hit the like button. It helps move this up in the algorithm so more people can find this content. Follow us in the land of X, Barb Armstrong CS, Kevin Horner CS. I don't believe we have a survey today. So thank you for joining us. Thanks to Kevin for all he does in the chat. And thanks to the guys behind the scenes for helping me bring this webcast to life. If you want to stick around, we've got, I believe it is Cameron May up next with getting started with options. And then at 2 o'clock Eastern, I will be talking about divergences and other fun stuff and getting started with technical analysis. Have a great day, everyone. Bye for now.